troubled banks getting some easy credit from the Fed. So are they now the new subprime borrowers?
Good question. Our Fox panel is here to talk about that. WCBS radio host Herman Cain is former chairman of the Kansas City Federal Reserve. That's Mike Norman, actually. There's Mr. Cain.
I haven't seen him in a long time, my friend.
Hi, Herman. Let's go back to Mike Norman now, who's from the Economic Contrarian Update, and Nicole Ridgway from SmartMoney.com, and Jim Pethokoukis is from U.S. News and World Report. Thanks to all of you. Herman, first to you. What do you think of this new attempt by the Fed to provide liquidity without lowering rates too much and putting more inflation in?
I think that's a good move, and you basically hit on the key point, and that is they want to encourage the banks to provide them a little bit more liquidity, but this should not be a signal that every time Wall Street gets skittish or the financial markets get skittish, that the Fed is going to be the sugar daddy. That's not why they are there. The second point I want to make, David, is the fact that they made a small cut. And some people were whining about why didn't they make a bigger cut. That's not their job. But here's the key point. And Tracy talked about it relative to a lot of the trading that's been going on Wall Street. People aren't trading based upon fundamentals. The banks have got to take this as an opportunity to loan money on fundamentals. And if they don't get back to that, no rate cut in the future is going to be able to bail them out, because that's just not going to happen.
Peter Schiff of Euro Pacific Capital is joining us as well. Peter, you've called it Fed heroin every time they come in with the Fed rate cut just to prop up the situation. What do you make of what's just been discussed?
This is a terrible idea. This is throwing gasoline on a fire. It's more inflation. I got two words for you, Liz. Buy gold. You know, it's no coincidence oil is almost up $4 a barrel today. It's not because of those numbers. It's because of the inflation that central banks are creating. It's not liquidity that they're providing. It's inflation. You know, when I was on the show last time, Mike Norman pointed out what a lousy investment gold was if you'd had bought it at $800 at its peak in 1980. But if you bought it 10 years earlier, in 1970, it was $35 an ounce. The people that bought it then, you know, made a fortune. And I think you're going to see a similar move in gold now. What we had in the 1970s with inflation and recession is nothing compared to what we're going to have now. That was the warm-up. We're going to the main event.
Mike?
I mean, I'm not even going to respond to that. We could all pick out snippets of data and say in this period, over the long term, stocks have outperformed. First of all, I want to say hello to my good friend Herman Cain. I haven't seen him in a long time. I have nothing to add. He's a brilliant man. What he said is absolutely correct. The Fed did the right thing. This is not a bailout of banks. The Fed does this all the time, provides reserves. Even in a good economy, it makes loans. These banks, as we heard from Sandra, they have to put up collateral. They have to show they're going to be able to pay these loans back. Look, the banking system is the bedrock of our economy. You don't want it to go down. If somebody's sick, you're going to treat them. You're going to give them medicine, put them in the hospital. They're not even sick. It's a psychological issue here. Exactly what Herman said.
Is that your idea of nothing to add?
What's the value of that collateral?
Yeah.
The collateral is wait, hold on, Herman, go ahead.
Yeah, let me add one more thing. I don't believe that Wall Street or the financial markets should be looking for another move on the part of the Fed for quite some time, because this should not be something that they expect every time they get skittish.
Herman, I just want to let our viewers know that looking at oil now, it's up nearly $4 to $94. We got the inventory numbers, but the crude market is rising here. At least some perceive more on the Fed action as it moves on adding money to help economic activity overall.
But it's also, Liz, what Herman said, the market is not reacting to fundamentals. You can make the same case for the crude oil market right now.
Nicole?
I think that the market is definitely not looking at the fundamentals. I think that they're just seeing this. They're trying to figure out whether or not this is going to be a Band-Aid or if this is actually going to help fix the markets.
If they were looking at the fundamentals, the market would be a lot lower.
Jim Pethokoukis, go ahead.
Well, I think the oil markets are looking at the fundamentals. What they're saying is that this move makes it less likely that this credit crunch is going to get worse, going to push the U.S. economy into a recession, and maybe drag down China or other elements of the global economy. This is why we have a Fed. I know some people like Peter probably wish we didn't have a Fed. He wants to look at gold, which I think is an irrelevant indicator, but he brings it up every week. I think once we get this credit crunch behind us, which we made a lot of progress today, we can let the good fundamentals of the economy take over and return to growth.
Peter?
Well, you may think gold is irrelevant, but the people who own it are making a lot of money. They're making a lot more money than people who own
It's irrelevant
US
as an
stocks.
economic indicator. You may make money off it, but it's irrelevant as an economic indicator. I'd much rather look at Treasury yields and a whole host of market-based indicators.
It's not irrelevant at all. You don't understand it because you don't understand inflation and what creates it. That's why you think it's irrelevant. But people who understand these dynamics, who understand central banks, know what gold is saying.
All right,
and that's
Peter,
why they own it.
I think we all understand inflation as we understand inflation. But the point is, I think the point that people are trying to make, Peter, is that you can still make a lot of money on Wall Street. My God, if you were to have invested in Apple, you could have made more than gold 3 months ago.
You didn't even have to do Apple. Listen, look, David, in 1907, we had a banking panic in this country, which nearly brought down the entire economy. This was pre-Fed. We didn't have a central bank. But guess what? Financiers led by J.P. Morgan came together. They provided liquidity to banks that were in trouble. In effect, the private sector came together and acted, in effect, as a central bank on their own.
We had the Great Depression with the Fed.
Hold on, Peter. Herman has been with the Fed before. What do you make of what Alan Greenspan, of course, the former Federal Reserve Chairman, is saying now, where he says you just got to let the free market go and let it play out instead of intervening and instead of trying to add liquidity here to save the situation?
He is absolutely right. Look, I don't believe this recent move was the direct result of what was happening in the stock market. I believe it was the result of analyzing a lot of dynamics and coming to the conclusion that now would be a good time to lower it by 1/4 of a point. Now, I would also suspect and expect that Mr. Bernanke and company are going to send a signal that don't expect this to happen again anytime soon. So Alan Greenspan is right. Now, the financial markets and the banks should have used the current situation as a wake-up call. If they didn't, free market dynamics are going to take over and screen out some of the people that are not doing business with strong fundamentals. Right. That's what they've got to do.
Gentlemen and lady, let me just bring up one point as we go to a break here that our friend Herman Cain, former chairman of the Kansas City Federal Reserve, is with WSB. Herman, great to see you. We'll see you a little later in the show.
Thank you.
Dirt cheap home heat. Well, a lot of talk going on, but are we losing our leverage with China when it comes to trade?
Let's bring back our Fox panel to hash it out. And we have, of course, Atlanta radio host from WSB, Herman Cain, former chairman of the Kansas City Federal Reserve, with us, along with Mike Norman and Peter Schiff and Nicole Ridgway from SmartMoney.com. Herman, what do you think? Are we handling this China issue properly?
All of the things that Secretary Paulson is addressing with the Chinese, that's just half of the issue. The biggest issue as to why we may be losing our competitiveness with China is our national debt. It is approaching $10 trillion. Now, for some people who may not remember, I know Mike Norman remembers, a trillion is a million, okay? A million. $10 trillion debt with $500 billion in annual interest. This is where we're losing our competitiveness with China, because as Congressman Duncan Hunter said in that clip, they are becoming our banker. This is where we've got to pull back. So Congress and the leadership in this country has got to do what it can do before it expects China to do some of the things we would like for them to do. So addressing the debt and the interest on the debt is one of our biggest challenges that we can do something about.
Mike Norman.
First, I'm going to respectfully disagree with my good friend Herman Cain, because the national debt, about $9 trillion, is only about 64% of our GDP. It's far lower than many other industrialized countries. I don't think that's a problem. I don't know if we ever really had much influence over China. I mean, they've been doing what they wanted to do for a long time. And by the way, it's been benefiting America. It's been benefiting our economy. We've been able to tap into that vast pool of cheap labor. We have access to cheap products. It's helped to raise our standard of living here in the United States. China is going to do what it needs to do simply because their policies are causing distortions in their own economy. You see now inflation running at an 18-year high in China. They're going to have to let their currency rise. And in fact, they are letting their currency rise, but they don't have the financial infrastructure there to just allow it to go overnight, a sort of cold turkey type of thing. But it'll happen.
Jim, what do you think?
Well, I think Herman's right that there's more things we can do to be competitive, but I think it has to do more with tax policy than it does with the national debt. But listen, our greatest foreign policy challenge, other than the war on terror, is managing this economic relationship with China. We want the Chinese economy to grow. We want to keep growing at a fast rate, so eventually those people become consumers who can buy our products. I mean, that's not happening right now because they're not rich enough, but that day will come. We just need to be patient.
Peter, is it our relationship with China, or, as Herman says, our relationship with our own debt that we should be worried about?
Well, look, we got a lot of problems. You know, Liz said that, you know, we are the Chinese buying American products. I mean, I'm an American. I don't even think I have any American products in my house. Why should we expect the Chinese to? You know, the whole argument is ridiculous. What the Chinese need to do is let their currency appreciate. That's the best thing that can happen for their economy, because then the Chinese can afford to buy their own products, and we would be stuck with just a bunch of paper money. I mean, they're buying all our bonds and buying all our dollars. I don't even understand why we're arguing with them.
Go ahead. Jim, go ahead. Let Jim respond.
I'll say, listen, there are some, I mean, China's currency is appreciating slowly. It's probably going to keep appreciating 5, 6, 7% a year. But the rapid appreciation of the Chinese currency would wreck that economy.
No,
and that is the last thing we need to lessen the global economy. You could actually have a breakup of China. If you think that'd be a foreign policy disaster.
It would wreck our economy. Look, they would get wealthier. Their currency going up means the Chinese get wealthier. They can afford to consume more. Think prices go down for them.
No, the Chinese economy, Peter, listen, the Chinese economy is driven in large part by exports. If they would allow their currency to appreciate in a fashion that, wait a minute, Peter, if they're allowed to let their currency appreciate in a fashion that you're suggesting right here, it would destroy their economy. Jim is absolutely correct.
You get the last word because we've run out of time, Peter. I know you want to get in there, but we don't have the time. We'll bring you all back. They are...
Are we getting close to a bank bailout now?
Let's ask our Fox panel, Mike Norman, who I heard chirping over to my left here for the Economic Contrarian Update. Nicole Ridgway is from SmartMoney.com. Jim Pethokoukis is from U.S. News and World Report. And Yaron Brook is of the Ayn Rand Institute. And Peter Schiff, the author of Crash Proof. Yaron, this is the first time we've seen you today. What do you think of this new plan?
Well, this is a bank bailout, as you suggested. There's no question about this. This is the Fed trying to bail Citibank and the rest of the banking industry out. And this is why stocks are responding in this way. I think that the market is interpreting this as the Fed thinks that the banking industry is in much worse shape than investors thought it was, and this is the market's response to that. But this is what the Fed does. It causes these problems, and then it tries to bail out the banks. And by bailing out the banks, it's going to create huge problems. You're going to see enormous inflationary pressures from this new $40 billion that's being brought into the system.
Mike, is that how it really is going to work out, that they make the mistake and then they try and bail them out?
Well, I'll get back to the point I made earlier. We didn't even have a central bank in 1907. A group of bankers got together led by J.P. Morgan. They did the same thing. This is not a bank bailout. Look, if you look at capital positions of the major banks, if you look at allowances for loan and lease losses, we're still way better than where we were back in 1990-91, even higher than where we were in 2000 to 2002 period. This is not a bank bailout. What the Fed is trying to do here is break the back of this psychology, try to encourage lending. And by the way, there's no indication in any of the lending data, if you look at commercial bank lending, commercial and industrial loans blowing through the roof, even consumer loans being made by commercial banks now trending up after a period from March to August. So there's no indication in the data that
Nicole, what the Fed says, hold on a second, Yaron. What the Fed says it's trying to do is to lower those interest rates, but not so much that it encourages inflation. So they're making it a little easier to borrow from the Fed, a little more discreet, because banks who've been reluctant to do that because they didn't want to go there and announce to the world that they were having trouble. Now it'll be a little more discreet in the way they can do it, so the names of those banks won't get out.
Right, and I don't think that the banks actually need a bailout right now. I mean, they do have reserves. They do have other ways and means to get money, cutting their dividends, issuing preferred stock, getting investments like Abu Dhabi. So, you know, I don't think that the Fed thinks the situation is that dire. I do think that they are trying to encourage the banks to, you know, make sure that they're not going to pass their troubles onto consumers by raising interest rates on credit cards.
Peter Schiff, Treasury seems to be worried enough about the banks to at least consider that super fund, which doesn't seem to really be coming to fruition. But when Nicole says that there are other ways of fixing the market, should we just allow it to happen and not get so involved in trying to finagle and fix something?
Oh, yeah, well, the government broke it, but they need to let the free market try to fix itself, and it can't be done easily. You know, whenever you hear the word liquidity, just substitute the word inflation. That's all the government can do. When we're talking about a government bailout, remember, the government doesn't have any money. All they can do is print money, which means they socialize the losses among the American population and people all around the world who are foolish enough to hold U.S. dollars and U.S. dollar-denominated debt.
You're on.
Well, this is the pattern. This is the historical pattern. In the 80s, they bailed out Citibank and other banks because they made bad loans to South America. In 1991, the Fed clearly bailed out the U.S. banking system because of the commercial real estate crisis in the 90s by lowering interest rates dramatically. They're doing the same thing here, and I agree with Peter. All they can do is print money. They can create liquidity, i.e., they can create inflation. And what they do is they just perpetuate the cycle. They by doing this, create the next bubble, and therefore the next bailout. And we pay for this. We just pay for it a little bit every year. We don't have a shock to the system where where everybody suffers. So nobody really pays much attention to these things. It socializes the risk, and it spreads it over a long time.
The savings and loan crisis that you mentioned there back in the bailout of the late 80s, 90s, that was a totally different thing. Those were S&Ls. They're not commercial banks. They don't make loans. They take money in from depositors. They turn around. They make that. The government came in. We had a 3/4 of a recession. You want to go back to the period of the 19th century where this was happening every 8 to 9 years. We were having bank busts and panic when we had no central bank. Millions of people lost their jobs. Tens of thousands of businesses and banks went under. We had depression on a regularity of every decade in this country.
I got to say something about the 19th century because I got to say something about the 19th century because Mike brings this up every time we're on a panel together.
We had the Great Depression.
To go back to the 19th century. I'd love to go back to the 19th century to economic growth at 8-9% GDP growth. That is the fastest rate in human history. And given the capital and the lack of technology, it's faster than what China's experienced today. Really no unemployment, absorbing tens of millions of immigrants. I mean, what could be a greater economy than the U.S. economy in the 19th century?
The point is, we don't want to go back to the 19th century. Not all of us want to go back to the 19th century where we're coming from.
We had a better economy back then.
Yeah, but we were coming from an agricultural society.
We didn't have refrigeration. Come on.
Exactly.
No Coca-Cola. Growth of the 19th century, not the standard of living in the 19th century.
Hey, there are countries that offer that right now. If you don't like it here, there's countries that offer that right now. You could move there. Okay.
Woo! Forget real estate. Well, Citgo and the Venezuelan government started delivering low-cost heating oil to Americans today. The president of that country remains a vocal critic of the United States. There's a lot to suggest this cheap oil is just a political ploy, but should people who really need cheaper oil just take the money and run? Just take this cheap oil. Let's go back to our Fox panel, see what they think. Mike Norman.
I say, as a policy, we should tell this guy to take his oil and shove it. Look, you remember after 9/11 when Rudy Giuliani, we got the $10 million check from that Saudi sheikh, but it came with conditions he criticized, and Giuliani said, here, take your money back. Look, we are an incredibly wealthy country. If we can't help out our own people, I mean, it's just kind of a sad statement. We have a strategic petroleum reserve. What's it going to cost us out of that reserve to help people who need some heating oil during the winter season? Come on. And now we're extending a hand to Chavez. Send back, just even if it's going to come back to us in some other cargo bound from somewhere else, send the oil back. Say no, just as a statement.
What do you think?
Well, it's clearly a PR ploy, but, you know, my concern is with the American government has no foreign policy agenda dealing with Chavez. He can come into this country and call our president evil, and you can love or hate George Bush, but no foreign leader should be allowed to come to New York and get away with calling him evil. But I say if he's willing to sell cheap oil, and the fact is that we have no foreign policy that relates to Chavez, why should these low-income people be the ones to suffer because, you know, and not buy that cheap oil? Let them have the cheap oil.
Jim Pethakakis, we had a small business company owner last week. It has been in the business for many, many decades, and his customers can't afford the price of heating oil as we head into the winter season. There is an ice storm slamming the Midwest. It's coming this way to the East Coast, and here comes Hugo Chavez on the white horse. What do you think people should do?
Listen, I mean, as a country, we import oil, like 10 to 15% of our oil imports come from Venezuela. So it's not, I think, such a terrible thing that that individuals get heating oil from Hugo Chavez. So I agree. There's things we could be doing as a country that Mike Norman pointed out so wisely. But listen, as far as our overall foreign policy, I'm a big believer in energy independence. It gets scoffed at like we can't do it, but I think we can do it and not be so reliant on some of these monsters like Hugo Chavez, who, by the way, I think is on a downward spiral in his own country. If he doesn't open up his own country to foreign investment, they're going to be producing less and less oil.
Peter, Chavez is already destroying his own company, PDVSA, so why not help him destroy it a little more by just taking some of his profits in oil for poor people?
Yeah, look, I'm not going to tell people who are struggling to pay these oil prices not to take the oil. What bothers me is why these prices are high in the first place, and it's because our own government, the Federal Reserve, is debasing the value of American wages. We can't afford to buy the oil because our currency is being debased. That's why we're having to spend so much money to buy it. We need to stop that. But you know, what the government did today, I wouldn't be surprised if oil is over $100 a barrel before the end of the year based on what the Fed did today.
There's a little something called global growth has a role to play into it as well.
It's global inflation.
Hey, Peter, explain something to me.
Growth.
Peter, from 1985 to 1988, the dollar fell 50%, yet oil prices came down 30%. So where now is this connection between the dollar going down and oil going up? Could
Remember,
you explain
it's not just the dollar, right? All governments, all central banks are debasing their money. Everybody is printing too much money. We're exporting our inflation around the world, so everybody is printing money, and so oil has to go up. I mean, it's no coincidence.
Guys, people have to heat their homes. So what are we going to do, become protectionist and not allow any imports of Venezuelan oil?
We don't buy anything from Iran, Liz. We still get oil from around the world. It's a fungible commodity. Cargoes of oil from Iran bound to Europe or Asia ultimately perhaps find their way, or parts of those cargoes find their way back here to imports we bring into the United States. Let's say no to this guy. I mean, Yoran, I have to agree with Yoran on this point. The guy comes in. He lashes out at our president. He ridicules him. We let him come in here. We give him this opportunity of free speech. Then, we stick out our hand. We could help our own people. We're the richest country on the face of the earth.
We're not the richest country on the face of the earth.
Should we take that Rudy Giuliani lead post 9/11 and reject that money that he felt was ridiculous coming along with that caveat from the gentleman who wanted to give it to, I believe it was Prince Al-Walid, was it not?
Yeah.
Well, no, I don't think that in this case we should. I think the United States needs to develop a foreign policy about Venezuela and to have sanctions against the country if we believe they are the enemy, if we believe this guy is really as crazy. But he's self-destructing. I mean, that's the beauty of somebody like that who's not really dangerous to America. He's not going to send terrorists over here to blow up buildings. He's a nuisance, and he's self-destructing. We should let and help him self-destruct. But we need a foreign policy about this. We don't put this on the backs of low-income people buying heating oil.
By the way, Jim, the story that we're downplaying here is the fact that this is a guy who is destroying his own oil company. Right. So if we leave him to his own devices, the Venezuelan oil probably won't exist much longer.
It's really the same problem with Iran. They have not opened their country to a lot of foreign investment. They need that foreign capital investment. And there's really a good chance that, in a few years, Iran will have to be importing oil themselves because they won't be able to pump enough. Same thing with, listen, the best way to deal with these guys ultimately, with these dictatorships, through trade, openness, they'll collapse under all that. And I hope that'll happen. All right.
By the way, can we take a look at Iran's shot again? I don't know if we can see that, but it's very artistic. Oh, now the light is on. We had a very creative mood lighting there for you. You're on.
We try hard.
Thank you very much. It works. All right. Well, 30 minutes.
I had the mood lighting.
30 minutes to the.
We said whipsaw action. We're looking at it now. Suddenly the Dow has popped to the upside. It's higher by about 18 points. We don't really say a roller coaster day on Wall Street here, but you know what? Today was definitely worthy of something right out of Six Flags.
Absolutely. Everything is suddenly green now, both the DJ, the NASDAQ, S&P, Russell. It's all green. Of course, so is oil and gold. That's not always a good thing for it to be green. But let us see what our panel thinks of this wild day. We have them all back, including Tracy Burns at the New York Stock Exchange. Trace, let's start with you. What are they saying about this day?
They're saying, holy Dramamine, where is it? That's what they're saying. Everybody's walking by saying, what a seesaw, what a market. I mean, it's been up and down all day, and for a lot of reasons that nobody really knows. A lot of it had to do with the financials. They didn't rally on the news that the Fed was going to inject money. So basically, if the financials didn't come to the party, why should anybody else? And that's kind of what happened today. Because, man, when that initial reaction when the money came in, early this morning, the market rocketed. It was like old school New York Stock Exchange down here. Everybody was running around and all fired up and buying and selling. And then I think the market digested it and realized, you know what, even that's not enough. We still have a lot to do. We have balance sheets to clean up. We have assets to put numbers on that we still can't do that. And the financials did not rally, and as a result, we came back down. Thankfully, we're holding in the positive right now. You know, volume picked up a ton, and the up volume and the down volume are pretty much equal, meaning the buys and sells out here are the same. So there's action, there's activity, but it's still a wait and see. You know, we get Lehman's numbers tomorrow. That's pretty telling. So at this point, I think it's like this, and everybody else seems to agree that it's going to be this roller coaster, Dramamine, Space Mountain from Disney World, Lightning Loops ride till the end of the year.
Space Mountain.
I think you left out one roller coaster, but I'm not sure which one.
That's the one that I probably threw up on, so I'm not going to mention it.
I'd want to forget that one, too.
The Matterhorn, it's an E-ticket, and here's the rest of our panel to talk about it. Nicole.
Yeah, I definitely think, you know, the fact that the financials didn't react was a little bit, I think that kind of set the tone for the day. But, you know, then you look at companies like 3M today coming out and saying, I'm going to have double-digit earnings growth next year. You know, there are some actual happy stories in this market, believe it or not. I mean, we're still going to have to deal with some negative news, but there are some places, like some optimistic spots.
Jim, the biggest question is exactly how the market digested the news of what the Fed did. I mean, we know what they did yesterday with dropping the interest rates. Then we woke up this morning with the idea of this new window that they were opening up for banks as a lender of last resort. What do you think the market thinks of that idea?
I spent all morning, calling people about this. I think people like this idea, but then again, all of a sudden the Fed unveils like a weapon from its arsenal that you didn't even know existed. So they're a little unsure about the Fed. They're a little unsure about the direction of the Fed. So I mean, that's going to cause a lot of uncertainty because they thought they had it figured out and they didn't. Now we don't have another meeting all the way until the end of January. So until people have a better feel for what the Federal Reserve and the direction of this economy, you're going to get a lot of volatility. Though I think, I hope I think we're at the nadir of the economy and we'll pick up nicely in 2008.
Peter, it's been quite some time since we've seen this much volatility over a stretch of a couple of months, and it has been a wild ride for the markets. It almost seems that the market doesn't know which way to go. So who's guiding it? How does it move?
Well, I think the volatility might be a sign of, a topping pattern. I mean, it looks to me like we could be carving out a head and shoulders top in the market with a neckline down around 12,500 for the Dow. If we break that, I think we can go to 11,000 very quickly. It doesn't matter how much easy money the Fed is pumping out. It's not going to go into the mortgage market. Nobody anywhere in the world is going to want to lend money to Americans to buy houses. Housing prices are still too high. They're going to fall substantially. There is so much risk in the mortgage market, nobody is going to touch it. They're going to take that money and do something else with it, but they're not going to buy mortgages. They're not going to loan it to Americans to buy houses.
But, Mike, there are mortgages being applied for. There are mortgages being given. Somebody's giving out that money.
Yeah, tell us something we don't already know. I mean, look, you know what I find? First of all, we're so down on ourselves. We're so pessimistic. We hear this sort of commentary, yet what is ironic, we see United Arab Emirates, we see Abu Dhabi, we see Chinese. They're running here to invest. They say our own institutions, our own banks, our own companies are attractively valued, undervalued. Billions of dollars flowing over here. Trade continuing on and on. I mean, why are we so down? This commentary, this sort of stuff that we're hearing day in and day out. And by the way, the market is up 7% on the year. It is not a disaster by any means. I think Jim is right. We're going to have a terrific year next year. The interest rates are reversing a trend that has been in place for the last 3.5 years. You know what, Liz? In your interview with Warren Buffett, he said something. You asked him about this rate cut. And he said, you want to know something? I don't pay attention to it. A quarter down, a quarter up, a half down. A year from now, you're not even going to know what the Fed... Look, I'm an economist. Sometimes I have to go back through the reports
really,
to
Peter,
find out.
do you remember what happened 13 months ago when the Fed met? If they did, there have been a million Fed decisions, and in the end, just invest the way you should invest, correct?
Sure, and based on what the Fed is doing, you invest abroad, you get out of the U.S. market, you get out of the dollar, you get out of U.S. bonds and U.S. real estate if you can. You buy gold, you buy commodities, you buy foreign currencies, you buy foreign stocks. the Fed is debasing the money, and it's going to have disastrous consequences for
Peter,
people who can't understand
children?
this.
Do you have children?
Yeah, we've established that I have a son.
Well, listen,
yes.
How can you, in any good conscience, raise children in this country if you believe so negative about the prospects of America? At least Jim Rogers, he's moving to China. He believes like you do. Well, I don't understand you.
Give me credit for staying here and trying to help people. I'm helping thousands of my clients protect their wealth.
Jim, we have to admit, as Warren Buffett told Liz once again yesterday, he's investing here. He's not looking at the changes every time the Fed decides to do something different. He's looking at specific companies and investing in those that look good,
Just
Jim.
not the dollar.
Hey, listen,
he's not investing in the dollar.
Right. So, yeah, he's doing what I'm doing.
Right.
But he is investing in dollar-based companies, Jim.
Mostly,
Jim.
Listen, long-term investors should love these kinds of periods because it'll give the opportunity not only to buy the U.S. market cheap, but buy some great companies which are going to get knocked down unfairly with all the rest. Warren Buffett still likes investing in America.
Hey, he likes Freddie Mac. He's the biggest, I think, individual investor in Freddie Mac. That's not doing what you're doing there, Peter. Well, I can tell you that right now. He's worth about $55 billion, a little bit more than you are, I think. I'm not sure because you own all that gold.
Okay, you guys can beat each other up on the playground after school.
Meanwhile, we are just...